The owner of OnlyFans has collected a $500 million windfall over the past 2 years from the booming popularity of the platform for adult workers and celebrities to sell content directly to their followers. The dividend payments to Leo Radvinsky, a Ukrainian-American internet entrepreneur, were disclosed by the UK-based company on Thursday as it unveiled a seven-fold surge in profits. For more on these headlines, we cross over to London, where we're joined by Lukman Otunuga, Senior Research Analyst with FXTM. Lukman, good morning to you. How are you assessing the performance of global markets this week?
Good morning, Rotus. Wishing you a happy Friday. Yeah, it's been a mixed week across the globe for global markets. This is the familiar calm before the storm we normally see just a few days before the NFP. Asian, European, US markets have been mostly mixed this week. Yes, we've seen some interesting moves here and there, but the truth is there's a sense of tension in the air with everybody waiting for the next fundamental spark, which could be the US jobs report later this afternoon. I think it's fair to say, whatever the outcome this afternoon, it will set the tone for September.
Indeed, it will. What do you make of the slump in bonds, global bonds falling into bear market territory?
I think it's a big deal for bond traders. It's the first, bear market in a generation. We've seen the bond prices have been tumbling on the back of aggressive rate hikes by central banks across the world to tame the beast known as inflation. We have to keep in mind that bonds are fixed income and they tend to fall in a high interest rate environment. But despite bond prices falling, investors could still be attracted due to the rising yields. Bond prices are inversely correlated to the yields. One interesting thing about this is, as yields continue to rise, this is going to impact the dollar and, of course, zero yielding gold.
And so that means, I guess, if we continue to see inflation climbing, then the global bonds are going to get punished.
Certainly, that's where we're looking at things right now. As inflation continues to rise and central banks continue to step into higher gear in regards to raising interest rates, the higher rate is what really impacts bond prices due to their fixed income nature.
Economists in a survey are saying that the ECB, the European Central Bank, has been slow to react to inflation, 9.1% August from 8.9% in July. What do you make of their sentiment?
If we want to be colorful, imagine this was a 100-meter race. The Federal Reserve, the Bank of Canada, and other super hawkish banks are near the finish line. Banks like the European Central Bank, the Bank of England, of course, and the Bank of Japan are still stumbling well behind. This is exactly what's happening. With inflation rising to a record 9.1 in Europe, many expect the ECB to switch into higher gear and possibly move to raising interest rates by a whopping 75 basis points in September. But given how things are, especially with the economic situation in Europe, this may not be enough, but we have to have more clarity and information for that. What we could say is, even if the European Central Bank moves ahead with raising interest rates, you have to keep in mind that the energy crisis in Europe and geopolitics and other uncertainty continue to weigh heavily on the European economy.
And let's talk currencies. Can anything slow down King Dollar, as you like to call it?
So I've got a confession to make. A few weeks ago, I was bearish the dollar. There's three things driving the dollar: interest rates, the U.S. economy, and of course the dollar's safe haven nature. A few weeks ago, there were expectations over the Fed's taking a step back on interest rates, and the fact that the US economy entered an official recession really hit the dollar. But it looks like dollar bulls are still unstoppable. The dollar's appreciated against every single G10 currency this week, this month, and year to date. As long as bets continue to rise over the Fed raising interest rates, we expect the dollar to continue pushing higher.
All right. And what about precious metals? I've been fascinated at how gold has continued to fall. I think it fell below $1,700 yesterday or so. And the whole safe haven discussion, gold seems to have lost that.
Yeah, things don't add up with gold anymore. One would think the geopolitical tensions across the globe, the recession fears, rising levels of uncertainty and all that stuff would send investors rushing towards gold saving embrace. But it goes back to the fact that gold is zero yielding and we are in a high interest rate environment. As long as the dollar continues to rise, along with treasury yields, gold is likely to remain unloved and depressed. That's why prices are trading below 17.0. If the NFP earlier today beats expectations, expect more gold to come towards more pain to come towards gold prices.
All right, so you see, I'm taking notes now. So interest rates rather inflation keeps rising. You might want to exit bonds, and also gold as well could be beaten down. So that's two investment destinations that folks might have to watch out for. Now, of course, for anybody watching, consult a financial advisor before making any moves on what you're hearing here. But Lukman, oil. They've retreated from where they were when the war started in Ukraine, February. What's your take on the performance, I guess, this week for oil?
Yeah, so we saw oil prices climbing slightly higher on chit-chat, whispers over OPEC possibly discussing output cuts when they meet next week. But looking at the bigger picture, it's still the same narrative. We've got concerns, we've got COVID restrictions in China, we've got a lot of uncertainty that may really impact the demand outlook. I think ultimately, though, when we look at the bigger picture, the drop in oil investments back in the COVID era, back in 2020, are likely to limit downside losses on oil. But looking at the short to medium term, I think where oil trades may be heavily influenced by what OPEC does next week.
But what about the geopolitical concerns? How much is that going to be impacting things? I mean, the war is still going on, right?
Absolutely. So we can see that in Europe, they're experiencing an energy crunch as Russia cuts supply. I think that's going to play a big deal in oil's outlook in the short to medium term. But I think in the bigger picture, as the supply and demand dynamics find an equilibrium, oil prices are likely to push lower in the longer term due to where the global economy is and how demand outlook may be hit should major economies across the world officially enter a recession.
Great stuff. About 30 seconds, Lukman. The non-farm payrolls, you alluded to it earlier. We got a surprise in July. I think it was 597,000 jobs that were created then. You think we get a surprise in August? Because some are saying that we might get a lower print later today.
Yeah, certainly. So markets expecting the US economy to have created around 300K jobs. This is based on, that the inflation, the damage of inflation and the uncertainty and negative economic data find its way into the labor force. My take, report that meets to exceed expectations should be enough for the Fed to remain ultra hawkish and move ahead with a 75 basis point rate hike. This is a case of good news is bad news and bad news is good news. So good US jobs report is likely to hit US stock markets and support the dollar as Fed rate hike bets jump. But a bad jobs report may see equity markets push higher and the dollar weaken as investors reevaluate whether the Fed will move forward with another 75 basis point rate hike in September.
So the news is inverted, like bond yield curves. Lukman Otunuga, Senior Research Analyst at FXTM. Always a pleasure having you, my friend. Thank you so much for joining us. It's the Global Business Report here on Horizon News. More after the break. Do stay tuned.